Welcome back to Future in Focus, a podcast on wealth and legacy planning. I'm your host, Antoinette Solomon. We've been talking about ownership, leverage, protection, the foundation of real wealth building. But today we're getting into the conversation that most people either avoid or only revisit in April, and that's taxes. If you're building wealth through real estate, business ownership, or any kind of legacy planning, tax strategy is not optional. It is one of the most powerful tools you have, and it's often the difference between staying stuck or scaling with freedom. To help us break this all down, I'm joined today by Mardochee Lewis. Mardochee is an IRS enrolled agent and the founder of MGL Consulting Group. With over a decade of experience in the financial space, from Big Four accounting to private equity and Fortune 500 advising, he brings a full spectrum approach to strategic tax planning and financial clarity. Thank you, Mardochee, for joining us today. I'm so excited for this tax talk because it is extremely important. So let's start at the beginning, right? Most people hear taxes and they only think of April 15th, W-2s, and we only think about refunds, right? But how should we be thinking about tax planning as a strategy throughout the year?
Yeah, definitely. You definitely want to think about your taxes throughout the year, and have a plan. First of all, you want to kind of think projections, like what do you project to make? What do you expect to make? Kind of looking like what you did last year, and build on that. Are you starting something new? Are you starting a new business? So if it's a new business, kind of like the projections may be difficult to project, but just understanding, your projections, understanding the different income streams that you have, rental properties, any investments, and just planning for it accordingly. And if you do have a business or real estate, you definitely want to keep track of all your expenses, some type of, QuickBooks or some type of, record keeping system that you keep track of all your expenses. And definitely important to work with a professional that can kind of keep you up to speed on what you can deduct, how aggressive you can be, and to be able to support those documentations.
Okay, so we shouldn't just be checking in with you in January when we know that April 15th deadline is coming up. So is that where like the quarterly tax payments come into to play?
Yeah, quarterly tax payments, and also like this. Look, obviously, you want to be mindful of how much you're making, and if you do need to make any quarterly payments, and also if you're a business or real estate, thinking through, okay, what are some possible expenses that you can write off on during the year? What are some items that you need, and just being proactive, and and buying those items instead of paying the IRS, because the idea is you're gonna have to pay anyway, regardless, right? You have to pay anyway. But how about be proactive and pay for something that you need in your business as opposed to paying taxes?
Okay, so that's good, right? Because we're not thinking about it strategically the way we should be. So you made a good point. Like there may be certain benefits for real estate investors or business owners that we need to be more mindful of. So you talked about deductions, right?
Correct.
I know for me as a small business owners, understanding deductions is extremely important because throughout the year we're paying for things. You want to make sure that you're being mindful of what your taxable income is. So let's talk about the deductions. What are some of the standard deductions that most business owners should be thinking about throughout the year that could be potentially deductible?
Yeah, that's a great question. The first thing I think about is mileage. As business owners, we're constantly networking, we're constantly going to events, meeting clients, whatever it is, and all those mileages, all that mileage is deductible. So just definitely having a way of tracking that mileage, logging it, is being proactive that way. Another deduction is a home office deduction. Taking advantage of the home office deduction. There's a lot of benefits there. There's also income shifting. Essentially, you can hire people in your family, your kids, and you could have the income shifted and take a deduction there. So that's a lot of people overlook that, don't even consider it. They also have the Augusta rule, essentially where you could like rent out, part of your home to your business. So that's another, possibility there. So there's a couple things that a lot of people don't really consider when it comes to their taxes. Yeah.
Let's talk about meals, right? Because we eat out a lot, right? How should we be thinking about meals to make sure that those are fully deductible?
Yeah, definitely. So anytime you go out, and you're meeting with a colleague or a client or any, and if you're talking business, you know, during the meal, it's a write-off. So essentially, meals are 50% deductible. So anytime you have a business meal, don't use your personal cards have a business bank account separate, right? You definitely want to have a separate business bank account, separate business credit card. You're keeping everything separate and just use that card every time you go out to eat, especially if it's business related. So just try to keep all your meals or dinners or lunches business related.
So you made a really good point about needing to make sure that you have a separate business bank account. But I see it all the time as an attorney. Some of these small businesses, they got the LLC, they got these things, but they didn't think about the business bank, right? And so they're commingling funds with the business, with the business assets, with the personal assets, and it's kind of making it a mess. So what's your sort of number one rule for situations like that? Like, how do we avoid an audit?
Definitely want to keep everything separate, right? Just like I said, just having a plan, right? So if you have a plan, so that's why it's important to start with a business plan and everything like that, because if you take the proper course of having a business plan, thinking things through, this is not something that you're going to miss, right? So you definitely need to start from the top, have a business plan, and work with someone. If you don't know what to do, work with someone that knows what they're doing, and you're not going to miss this. But definitely want to have a separate business bank account, use everything separately. Not only that, you want to keep track of the receipts, and also have some type of record keeping system so you can keep track of it, because the business bank account is only one piece. So that you want to have a complete piece of the pie, right? So when you're eating a pizza, you don't just eat the dough and the sauce. You have the dough, sauce, cheese, and toppings, right? So the same thing when it comes to your business, right? You got to have a business bank account. You got to have your QuickBooks. You got to have your receipts. It's a complete package, and you can't make any assumptions. That's the thing. A lot of people don't educate themselves and they make assumptions, and you can get yourself in trouble, So like at any given time, you should be able to know how much money you made or expensed up to a given point in time. So let's just say you don't know how much money you made as of right now. You should know how much you made up until March 31st.
Okay.
Maybe you don't know right now because you didn't update April, because right now we're currently in April. But you should know up to a certain date, I'm good because you worked up to that certain date. Okay, well, I don't know how much money I made, but in the first 3 months, I made X, Y, and Z. In the first 3 months, I spent X, Y, and Z. And I made profit-wise X, Y, and Z. You should know that. If you don't know and you're going out the whole year running a business, having a lot of activity, not knowing how much money you made, and you're waiting for your accountant to tell you in February how much money you made, wrong. Incorrect.
Yeah.
You should be knowing that throughout the year. And if you can't do it, if you can't handle it yourself, you need to be working with a professional.
So that's a great segue into my next question. As small business owners, when should we be engaging with accountants, bookkeepers, and those kinds of professionals?
I think anytime that you have a good like stopping point in your business, or like a transitional point in your business, and obviously at tax time, or also before the year ends. So like, let's just say you're starting a business. You're thinking about starting a business. You should be talking to your accountant. If you're thinking about applying for a loan, you should be talking to your accountant. Anything you should do that impacts your numbers, you probably should be informing your accountant so to make sure that you're moving accordingly and you're making the right decisions.
Yeah.
So anytime that you have like a a pivotal point in your business career, you should be talking to your accountant. If not, you should be talking to them monthly or periodically. Some people, they may not have the budget to work with an accountant on a monthly basis, but you should at least check in, once or twice a year before the tax year ends, because you want some advisement to say, okay, am I doing this correctly? Because if you come in February and the year's over, the year is over. There's nothing we can do. But but if you check in with me in August, and then in October, and then we can do the tax return, I can kind of help you avoid some mistakes.
Okay.
Before the year ends.
All right. Give us an example of a common mistake you see.
A common mistake?
For small business owners. What are they overlooking?
Okay, so one common mistake we touched upon is commingling.
Commingling,
yeah. They'll use their personal and business. And I'd be like, no, you shouldn't have done that. Also, saving your receipts. Some people think that just having a bank statement is enough. If you have a record-keeping system and you're properly keeping your deductions, the IRS only requires you to keep a receipt if you spent more than $75. Now, if you're not keeping proper record keeping and you don't have a system, you're not organized, well, they want every receipt, right? So how are you going to prove it if you don't have an organized system? They want every receipt in that particular point in time. And also, people don't realize that the receipt breaks down what you actually paid for. A lot of people think, oh, what about the bank statement? Well, the bank statement, you can have a lump sum number, and that lump sum number is made up of multiple things. So how can we tell
what it was.
and how can we tell if it's deductible or not? So that's why you need the receipt.
Okay.
Yeah.
That's helpful. So let's shift a little bit to talking more about real estate, and that for our real estate investors and landlords like myself, multi-property owners and things like that. What are some key tax moves that they should be thinking about? One that comes to mind immediately is understanding a 1031 exchange, right? Like that is a huge sort of tax planning strategy for real estate investors that I don't see used enough.
Right.
So what are some tax considerations that they should be thinking about when acquiring all of these properties?
Yeah, definitely. So you definitely want to consider like all your exit strategies and all the possibilities, that could happen with the real estate. You mentioned 1031 exchange. So 1031 exchange, essentially, if you're selling an investment property, you can defer your capital gains as long as you identify a new property within 45 days. And also, you actually close on this property within 180 days, which is 6 months. So those are the two stipulations. And if you do that, you can defer your capital gains, for the future. So, and you can literally keep doing this and doing this and doing this, until you pass away, and then you can pass on the real estate, to your heirs, that way. So that's a 1031 exchange. And then other things to consider is your income levels too, like how you're cash flowing on the property. So that may impact you getting a new property. So you want to consider, okay, a lot of people would like losses and not reporting any profits, but if that's going to impact your ability to purchase a new property, you want to consider that as well. And definitely, a lot of real estate people, they don't, put as much of an emphasis on the bookkeeping. Most of the business owners do, but I feel as though real estate people should be utilizing bookkeeping as well, utilizing softwares like QuickBooks and everything like that. So that'd definitely be an asset to real estate investors.
Yeah, you're absolutely right. I see it all the time. People come to me for sort of the legal side, right? They're like, we need this partnership agreement. We need this, put together pretty fast. But they're not thinking about the other side, accurate record keeping and making sure that they're getting all the tax benefits of everything, because you could be losing out on some deductions, right?
Right. Definitely. And there's two more things I want to mention, right? Is capital gains. Definitely.
Let's talk about capital gains.
Yeah, so if you live in a home, at least 2 of the last 5 years, 250,000 of the gain is tax free, and if you're married, it's doubled to 500,000.
Ooh, so I didn't know about the married one.
Yeah.
Okay.
So if you're married, it's doubled to 500,000, and you're an attorney, right? So like I know you guys have probate assets. And non-probate assets. So I believe if you're married, it's a non-probate asset, right? If you're married or something like that.
Well, it depends, right? Like how it passes down.
So so I'm not sure.
We can get into that.
Yeah, I don't want to get too technical, but just considering like possible trusts that you may want to put the home in, so it doesn't go through probate and everything like that. So that's another consideration. You want to consider your possible exit strategies. If you purchase the home with someone, right, and just having an operating agreement and some type of exit strategy, like if things go south, especially if you're not married to this person. So things can happen. So.
You're absolutely right. So now that takes us into what my sort of specialty is, right? Estate planning, legacy planning, setting up trust, and all these different things. We want to make sure that we're advising our clients, in the right way, so that not only is estate planning central, but taxes are, right? So in these sort of wealth building strategies, right? Inheritance, gifting, trust, how should we be thinking about taxes?
Yeah, definitely. That's a great question. There's definitely states that are more favorable towards estate planning and trusts than others. So you just want to be mindful of where you're living and where you're establishing these trusts and estates. For example, New Jersey has 0% estate tax, and there are other states like Florida and Texas that are notorious for that. So just being mindful of where you structure your entities is very imperative.
Yeah, and that's why it's important, right, to have your estate planning attorney, your accountant, your financial advisor, life insurance agents, all of these people kind of working together to make sure that you are most protected, right? I know, for example, with the gift tax, right, like if you give more than $10,000 to somebody and you die within 5 years or so, I think it's 5 years, if you die within that time period, the state can look back at the gifting that you gave and potentially assess a tax on whoever you gave that gift to.
Right.
So you just want to be mindful with those kinds of things.
Right.
Yeah, I know for like with trust, right? Like if you have assets that you want to transfer directly to somebody in your estate, those will be assessed an inheritance tax depending on who the person is. But if it's in a trust and they make distributions, they still might get hit with a tax, right? Like they still may get hit with some sort of income tax based on that distribution.
Right.
But that income tax could likely be less than the inheritance tax.
Right.
So it's all about like strategic planning, right? Making sure that we're having all these conversations, not just in a silo, that all of these professionals are talking and keeping each other informed to make sure that your strategy is continuing to be executed on, right?
Yeah, definitely. And one thing I wanted to add is that when you do have a trust, there are certain, you have assets that produce income, and sometimes people want to have that income distributed. So you just want to be mindful that the assets that you're distributing are distributable assets, because there are certain assets that produce income that can't be distributed.
Yep.
So you just want to be mindful that you're distributing income that's distributable. So that's why it's good to work with someone that could help you determine that.
Yeah, that understands the full sort of realm, that isn't just a bookkeeper or somebody that's just kind of like doing your taxes.
Correct.
You want to work with a CPA, an accountant, somebody who understands the full realm of your whole tax planning strategy, right?
Correct.
Yeah, so that's good. All right, so let's get into some common mistakes, right, that you've seen. What's one thing that you see entrepreneurs get wrong with their taxes?
Business setup. Just setting up a business
Okay.
properly.
All right.
I actually had a client come in and he had an S corp done last year. He showed me his 1120S, but I looked in New Jersey. He's not registered in the state of New Jersey as an S corp. So I'm like, how did you file an 1120S? if you're not- So that's just that right there. Like, you're not working with someone and properly setting up your business. Like, well, I looked you up. You're not even in the system. So setting up properly that way. Also, LLCs not properly, keeping deductions.
Yeah.
If you don't properly keep your deductions all year round, you could be leaving things on the table because you're not aggressively looking. Hey, you forgot about that one thing. You might have bought a piece of equipment, or you might have traveled to a place, and if you don't properly, if you're not on it, you miss that deduction. Also, properly switching over from an LLC to an S corp. Actually, I recently had a client come in, new client. Had they seen me last year or earlier on, or a couple months earlier, I would have advised them to file a 2553 and become an S corp. But they didn't do that, and now they ended up owing a substantial amount of money for 2024. Now we're on the way to getting them to become an S corp for 2025, but for 2024, it's already done. You know what I mean? So they have to pay that. So.
And when would you, like, because that's a really good point you made, right? That switch from LLC to S corp. I did a lot of corporate restructuring at the firm, and even helping companies prepare to get private equity capital, right? Like, or get VC capital. Usually they want you structured as a corporation. And so you got to go through this whole restructuring process. Had you done it in the beginning or earlier in the process, it may not be, as exhaustive, right? Because a lot of times you've gotten all of these assets under this entity. Now you're going to transition everything, retitle everything. It's like a whole process. So when would you advise somebody to have that conversation about potentially switching from an LLC, solopreneur, sole proprietorship to an S or C corp? When is the trigger for you?
Well, for the S corp, essentially, when you're making a substantial amount of money, or an amount where it's like, okay, it makes sense to switch over. Typically it's about like 50, 60,000, 40,000. It just depends on the person. Everybody uses their discretion differently. People make that decision at different points in time, but generally around that point in time. And also, you want to be able to pay yourself a reasonable salary. So until you can pay yourself a reasonable salary on a W-2, you probably should hold off on becoming an S corp. So definitely pay yourself a reasonable salary on a W-2, and that would be a good time to become an S corp. Now, C corp, most people become a C corp if they're required to. So I had clients that they took money out of their 401k or retirement or whatever the case is, and they kind of were required to become a C corp because that was the only way to take the money out.
Okay.
I've had clients like that. Or, the thing with the C corp is that you can have an unlimited amount of investors. With an S corp, you can only have 100 or less. So if you plan on having a substantial amount of investors, then you may want to become a C corp because you have an unlimited amount. But the only issue with becoming a C corp is that it files its own tax return and it pays its own taxes. So that's the only entity that does that. All the other corporations, the S corp is a pass through entity. So the S corp itself doesn't pay tax, but the individual, the shareholders do. So it's passed on to the shareholders. So.
Okay. And now, for people who, like I said in the beginning, right, for people who just think about taxes in April, is there something that they could be missing out on? Is there any tax benefits that could be, or maybe some time periods that they, some timelines that they could be missing? Is there anything that we should consider throughout the year for tax planning that we're not thinking about now?
I think everybody should be looking at their income and just saying, okay, based off my income, how is it going to affect me towards tax time? Because I feel like too many people are surprised at tax time. I feel as though that shouldn't be. You're surprised because it's like my token slogan is "Welcome to America." I would say, you're right. Where have you been? You know what I mean? The rules are here. You know what I mean? So it's like you're living here, you're making more money, you're trying new jobs, you're doing real estate, you're trying all these new endeavors, and to be honest, taxes affect everything that you do. So for you to not know is kind of irresponsible, in my opinion.
Yeah.
If you think about it, because the taxes affect everything you and you know that, and then you know that, and then you complain at the end of the year. It's really mind-boggling the amount of people that just really don't know their tax situation.
Yeah.
You should take more control. I tell you should take more control of it.
Yeah. I can see you saying that.
You should care more.
Yeah.
You should probably care more. You should probably start a business and keep track of your stuff and write some things off. You probably should care more. You really doesn't. A lot of people, they really don't make this a priority at all. Yeah. It's like not even a priority at all until
tax time.
I want to get $3,000.
Yeah.
How? You
owe $3,000.
Exactly. Yeah. You haven't done any planning. You haven't looked at your situation. You haven't considered your income streams. You want to buy rental real estate, but you don't know what the tax implications are.
Yep.
So like, if you don't know, you can't just sit there and just say I don't know and just do what you think. That's how you make a mistake.
Yeah.
So you got to kind of do the research or kind of work with someone that can kind of help you out. So I feel like there needs to be more widespread. I don't know what the acumen. I don't know if or practice.
Yeah, more of a tax financial acumen that you need to gain.
Yeah, but there should be more regular practice of utilizing a tax advisor as opposed to just a tax preparer.
Absolutely.
Because that's gonna give you better results if you work someone on the front end as opposed to on the back end. Because he's just telling you what you did. I'm just giving you the results as opposed to we can kind of like predict and kind of like control what's going to happen. You know? Because it's more futuristic. When you're doing your tax prep, it's more like the past. You can't do nothing about the past.
Exactly.
But you're doing advising, you're doing something about the future. You can do something about the future.
Yeah.
And you can change that. So
that's why you say you like to advise people on tax planning.
100%.
Not just a tax preparer, not just a bookkeeper, not just an accountant.
Yes.
Like I'm here to advise you on strategy, which I love. So let's kind of pivot a little bit and talk about how has your perspective on money changed, especially since transitioning from, moving from corporate to consulting, right? How has your perspective on money and legacy and planning changed?
This is a question that nobody has ever asked me. They probably should.
Really?
Yeah, I'm probably the perfect person.
I'm an amazing interviewer.
I'm probably the perfect person to do this. And you asked about best practices. I calculate my net worth monthly.
Wow.
I used to do it quarterly when I was in corporate. And what happened when you did it quarterly is that I wasn't doing it frequently enough. And sometimes I would forget. Like now I'm more on it. Right now I'm fully responsible for my finances. I don't have a paycheck coming in. I'm everything.
Yeah.
Right? So I have to consider things more
intentional.
Exactly. Like I gotta think. I think about my budget from an annual perspective.
Wow.
Forget a month. That's not enough. That's how you get in trouble because you might run out.
Yeah. Not thinking about some expenses down the road
100%.
that you didn't include in that budget.
Yeah. So for me, I already know. For me, it cost me probably like $53,000 to live in the United States here.
Yeah.
I'll probably add another 5,000 for the holidays
Yeah,
and
give
the
you a little,
kids.
but yeah, a
Yeah, for
little.
the kids and the
Mhm.
holidays, and for
Oh,
stuff
you a
like
good
that.
uncle for $5,000.
Well, not well. It's spread out throughout the
Yeah, throughout the year.
year,
Okay,
and
that's
then
the max
for
budget.
miscellaneous stuff. 'Cause
Mhm.
that's another thing too. A lot of people don't. They sell themselves short.
Mhm.
Like there's no point to oversave just so you can go back into the account and go get it back. Like you
Mhm.
oversave. Let's save something that you don't have to go back and grab.
Mhm.
I know that emergencies happen, but you don't want to go back and grab something for something that's not that you didn't. You could have just put it in the lineup in the budget as opposed to
Mhm.
putting it in there because you don't want to. The thing is, every time you dip into your saving, it's a bad habit.
Yeah, it is.
It's a bad habit because you're gonna keep doing it.
Yeah.
Because if you do it once, it's easier to do it again and again and again and again.
Because why not? It's there.
Exactly. So
Mhm.
for me, if I put something in my savings, I try to be like, you know what, just leave it in there.
Yeah.
That's really for that, and then I try to figure it out, or I just work harder.
Mhm.
A lot of I'm big on education, right? Like I like to read, and I feel like people need to like learn something else.
Mhm.
Like for instance, I got a point in my life where I was like, all right, well, I need more money. I learned to be referee.
Mhm.
I learned to be referee. I was a basketball referee for 8 years.
Wow.
I did AAU,
Mhm.
men's leagues,
Mhm.
a little college stuff here and there,
Mhm.
but I did it and it helped me produce an extra like $10,000 to $15,000 a year.
Wow.
You know what I mean? So that's his example right there. Like, sometimes you have to do stuff like that
Mhm.
just to, make ends meet, you know what I
Yeah.
mean? Or just to save,
Mhm.
It's not to tap into your savings is that, oh, what can I do to add to what I'm already doing? I was already an accountant,
Mhm.
working at Ernst and Young.
Mhm.
I got my, I could be prideful. I'm not gonna be a referee. No pride, no ego here. You know what I mean? I needed the money.
Yeah, because ultimately it's about your plan.
Yeah,
Right?
100%.
You planned strategically. You saw that there was a gap and you were like, I gotta fill this gap in some way.
Yeah.
It's not, oh, I gotta get rid of something. It's no, I gotta add something
Yeah.
here so that I can make, cover it and I can continue to live my life the way I want to live it.
Right.
So I love how the entire talk has been about being intentional about your taxes
Yeah.
and properly planning, speaking to the right advisors and making sure everybody is having the conversations to make sure that you're not paying a huge tax bill at the end of the year.
Yeah.
So before we wrap, I want to highlight this great community event that you've organized. So you told me that you are also the founder of the Slim Bees Classic, which is a basketball tournament created in honor of Sherrod Coleman, who was tragically killed by gun violence. This event has been a fixture in the North community for the last few years. So can you tell us a little bit more about what this means to you, why you started it, and who was Sherrod?
Okay. Great question. Thank you for bringing this up. Sherrod Coleman was my teammate in high school. We played basketball together at West Orange High School on the basketball team, and he was a good friend. And growing up in West Orange, we have a good camaraderie, especially when it comes to sports and basketball. Like we had like leagues there, like different churches and parks and organizations that would host basketball, leagues for us and tournaments as we were kids from 6th grade up until like we were in college. And I kind of started this tournament kind of to emulate that, kind of emulate our childhood. And that same year I was gonna bring that tournament, Sherrod passed away, right? So he was killed, gun violence, everything like that. And it really shook up the whole community. Like literally my social media feeds were like everything with Sherrod, this and that for days, weeks. And now it kind of touched me. I'm like, well, I'm doing this tournament. It's kind of like, it kind of touched my heart. I'm like, you know what? I'm doing this tournament for the community. We all come together. It's hurt us. I'm going to just call this the Slim Bees Classic. As soon as I did that, like, I felt like the talent level kind of increased. Certain people kind of came out and played and stuff like that. There's this dude, Isaiah Briscoe, he played at Kentucky and stuff like that. And he played in the tournament.
Wow.
And, he was the #1 point guard in the country.
Wow.
Yeah, out of New Jersey. And, like, outside of, like, Kyrie Irving, I don't really, in my opinion, I think he was probably the most popular high school basketball player. Primarily from New Jersey. Primarily because he was the #1 point guard at the time.
Yeah.
And then his freshman year at Kentucky, he plays in the tournament. And like when that happened, that's when like everybody was like, "Oh,
This is huge. I
Yeah,
need to be a part of this.
I need to play a part of this, and I need to start recruiting better players.
Mm-hmm.
You know, because you see
Yeah.
Isaiah Briscoe out there, hezzy, you know.
You want to prove you can do
Exactly,
something.
exactly. And then there's a dude, Jesse Jones,
Mm-hmm.
Filet. He's a big social media guy. You know, he played in the tournament. So once those guys started playing, I started getting other guys, Asante Gibbs, Tyshawn Taylor, all these guys that, you know, Jersey, you know, legends and everything like that. And there's other guys too that people may not be familiar with that play and, you know, talented and everything like that. So it kind of became more, you know, more popular, talented players, and we're promoting positivity, have different organizations, and we have sponsorships. You know, we're also doing sponsorships. We're accepting sponsorships now. You know, we got sponsorship packages coming out.
And when's the tournament? When and where?
Okay, it's July 20th, Sunday, July 20th at West Orange High School. So we just got West Orange High School. We went there. I went there. You know, Sharon went there. So that's big.
That's amazing to have your alma mater support this.
Yeah, definitely big.
And there will be sponsorship opportunities.
Yes.
So it's an
100%.
all-day tournament, right?
All-day tournament.
When do the eligibility requirements come out? Like, when can somebody start to sign up to actually have a team or be a sponsor? Where can they visit to get more information?
Definitely. We definitely have more information launching by mid to late April. We'll have a website launched. You know, we have a flyer launching, everything like that. So just stay tuned, you know.
Yeah,
Everybody.
make sure you follow Mardochee on
follow
social
me.
media.
Yeah, follow me on Instagram. You know, Doche Detached Guy.
How you spell that?
DOCHE_THE_
Tax
guy. Tax guy _ Yeah, I had to think. Had a little brain fart.
Okay.
Yeah.
All right. Well, that sounds amazing. I really hope that I'm a part of it. I can't wait to see you bring this to life, and I'm sure it will continue to be big because Sherrod clearly made an impact on you and on the community. So it's amazing that you're continuing his legacy and doing this in honor of him.
Yeah, thank you. Thank you a lot. You know, that really means a lot.
Of course. Well, thank you, Mardochee, for sitting down with us and talking all things taxes. The theme today was definitely be intentional about your tax planning. Don't just wait until, you know, April to think about taxes. Get with an accountant, get with a bookkeeper, somebody who can advise you properly throughout the year, and then you won't be shocked come April 15th or whenever you file them, right? Because a lot of us get those extensions. So, Mardochee, thank you so much. I really appreciate it. This conversation was full of gems, and it reminded us that building wealth isn't just about what you earn. It's about what you keep, what you protect, and how you pass it on. Now, to everyone listening, tax planning is not just a technical issue. It is a strategic tool. And the sooner you start using it intentionally, the more room you create for growth. If this episode resonated with you, please share it with someone you care about. Make it a conversation. Subscribe to the show. Leave a review. It helps others find this space. This is Future in Focus, a podcast on wealth and legacy planning, where strategy meets legacy. Until next time.